Thanks for watching this Magellan quarterly update. Today I'm speaking with our co-founder and Chief Executive and Lead Portfolio Manager, Hamish Douglass. Hamish, we've seen recently the pullback of some technology-related holdings and companies. Does this signal the bursting of a tech bubble?
Well, Frank, let's put this in perspective. You know, media can get very carried away. A lot of the large technology companies have had very strong share price runs in the last 6 to 12 months. And in some of them, we may have had a 5% or less share price pullback. If you read some of the media articles, you think there's been a crash. So let's put it in perspectives. It has been incredibly modest, and some of the share prices actually haven't even moved. Look, I think this is very, very different to what was going on in 2001. In 2001, we had largely unproven business models on extraordinary valuation multiples, many losing money and talking about multiples of revenue as new metrics of valuing businesses. And of course, that was the tech bubble that burst. Today, we're seeing very, very real business models, and some of them, their competitive advantages are literally widening by the day. If you take a business like Apple, it's a business that's earning $48 billion probably this year. Google's probably going to earn $30 billion US dollars this year, and Facebook maybe $18 billion US dollars a year. And some of these are virtually global, either oligopolies in operating systems, in mobile, close to a monopoly in terms of search-based advertising in many developed countries of the world, and in social media, close to a monopoly in the developed world. Of course, we've got lookalike businesses in China in those businesses. So these are real businesses with almost infinite returns on capital, with some of the largest profitability the world has ever seen. And I think they're trading on pretty attractive valuation multiples. So it's a general thing in large cap tech. Are we seeing a bubble at present? Absolutely not. Are we seeing a little bit of share price pullback after a lot of runs? In some cases, we're seeing a little bit of share price pullback. I should say there are other areas of tech, maybe earlier stage tech, some of the unlisted tech stocks, or some very high growth businesses that just aren't nearly as dominant. And there could be some overvaluations in that space, but that's to be expected wherever we have markets operating.
So Hamish, on these companies, how do you view the pricing of some of these larger holdings in the portfolio, like Apple, Alphabet, Facebook?
It's a very good question, Frank. Obviously, they're some of our largest holdings in the portfolio, and if I thought they were overvalued, I would have sold them. So by definition, I don't believe they're overvalued. If you look at Apple, our largest holding, and you know, in the last 12 months, it's up 50 or 60%. And why haven't I sold it? Well, Apple's still only trading at around 14 times this year's earnings. And it's at the beginning, we think, of another upgrade cycle with the launch of the iPhone 8. Of course, we don't know exactly how that's going to go, but the potential, they've been waiting to upgrade their phones, many iPhone users. We think that's going to bring forward. And more importantly, we have to look whether it introduces new users into the iPhone ecosystem at 14 times earnings plus their strong growth services business. I think Apple still remains very attractively priced at the moment. Alphabet is trading at a higher multiple. It's not at sort of 14 times earnings. Maybe it's trading at around 25 times this year's earnings, actually slightly less than that. Their core business has been growing at 20 to 25% a year at the moment. Its search business is absolutely dominant, but there's a lot more to the Alphabet story than just the search business. Within that core search business, there are a number of other businesses that are in very early stage of monetization that have the potential to be absolutely enormous. One would be Maps, and Maps is all about locally based advertising, connecting people where they are to local businesses and local inventory. We're in a very, very early stage of how local advertising can get monetized, and that is an absolutely enormous market that's currently, in revenue sense, very small for Apple. Then we have the YouTube business. There is still around $200 billion a year in advertising on television. We're nearing the apex of a fundamental shift in the form of video-based advertising. And YouTube is one of the few platforms in the world of the new over-the-top platforms that has been developed as an advertising model as opposed to a subscription model. And therefore, we would expect YouTube to be a massively larger business in the future than we have today. And in a revenue sense, it could potentially be as large as Alphabet is today. And the last business within that core business is their cloud infrastructure business, Google Cloud. At the moment, I estimate there's probably around $30 billion worth of cloud hosting infrastructure revenue in the world at the moment. The total addressable market is estimated at over $1 trillion US. And there are probably three big competitors in the world in this early stage market, one being Amazon, the second being Microsoft, and the third being Google. So we've got three massive businesses, and I'm paying maybe 24 times earnings for that. And on top of that, within the 24 times earnings, if I stripped out their cash and the losses they're suffering in what is known as other bets, other businesses, losing $4 billion or so a year at the moment, it's probably trading for those other businesses at about 17 times earnings, which is in line with the market. So in no way could you get to a conclusion that there's some bubble valuation in an Alphabet at the moment. And Facebook is trading at 25 or 26 times this year's earnings. Last year it grew at 50%. And it's a very dominant, and it's got other businesses, particularly their messaging platforms, both Messenger and WhatsApp, and Instagram still in very early monetization. Of course, the core Facebook property, we don't view that as an expensive price. So no, we're not seeing bubble valuations in those core technology stocks. We're actually seeing an enormous amount of value in that space. Notwithstanding their prices have gone up materially in the last 12 months, but so have their earnings, particularly in the case of Alphabet and Facebook.
And Hamish, Amazon recently announced the acquisition of Whole Foods, and we've seen a lot of the global retailers being sold down on the back of that. What do you think the implications are for Amazon with that acquisition?
Well, we don't own Amazon, but we follow Amazon incredibly closely. It is an incredible business, and as I've said on many occasions, Bezos is probably the business person of our generation. I think the Whole Foods acquisition is one visionary and a seminal moment in terms of what can happen in retailing in the world. At the moment, the Amazon platform is not a weekly shopping platform. It's kind of a platform for occasional purchases, and it's key for their business model to get involved in the regular weekly shop, and to do that you have to be in groceries. It is very difficult to fulfill online a weekly shop because of fresh foods and chilled goods. And to get that, you really need a physical store location for that component. Buying Whole Foods Markets probably gets them the best fresh food offering with a very good store footprint that's not too large, 460 stores in the United States of America. At the moment, it's a very upmarket, very expensive offering. If Bezos can bring down the price of that fresh food offering but keep its quality at an exceptional level, and I believe he will do that, he's going to attract more customers to those stores. And once he can attract customers to that grocery stores, he could then use logistics and other things to start fulfilling a regular shop, and either other Amazon goods could be picked up at those stores. If he can insert himself into that fresh food regular shopping, and then he can integrate his logistics for his rest of the business and use that new infrastructure with the rest of his infrastructure, he could fundamentally change the game in grocery retailing in the United States of America. So do I think it's going to be important? Obviously, there's a lot of work to do. It's very early days. It's visionary, and it's probably not going to be apparent to people for a while whether or not this is really going to work. I think it will work over time if they can sort out the technology and logistics, and they could take a meaningful amount of market share in the market in the United States, in that regular weekly shop, and then tie it in with the rest of their business model.
And so, Hamish, do you think that has implications for the investment thesis for companies like Costco and Tesco?
That's a very, very interesting question. On Costco, at the moment, we're not overly concerned by that move because Costco isn't involved in that regular weekly shop. It's not a grocery operator per se. It's a membership model where people are going to either get fuel or they're getting a fairly irregular large bulk shop and they're going for a mystery shop, or they're a small business who's doing large pack size shopping at at Costco at incredible value in large volume. I think that's very different to going down to the store to buy your bread and your milk and maybe pick up a steak, which is really what Amazon's trying to get in that very regular shop, and it's incredible value, but we have to watch it closely. Fuel is still a very, very important part of the Costco business model of delivering amazing value to customers. Ultimately, in the long term, we have electric vehicles. But the Amazon move, I don't think, is going to underplay the value proposition of what Costco offers to small business and customers. Remember, customers are either paying $60 individually or $120 for a business membership there per annum. So sort of between $5 and $12 a month or so for that offering. Tesco, obviously this hasn't happened in the UK, and Tesco doesn't have a business model in the United States. What we have to think about, Amazon is present in the UK. Whole Foods has a few stores in the UK, but largely they don't have car parks and that type of thing. So the logistical issue of what they're trying to do in the United States won't really work. But if they were to go and buy another chain and try to replicate, assuming the Whole Foods model works, that could have an implication in any market if Amazon went there. There isn't a replica network that looks like Whole Foods markets in the UK that can provide a very high quality, fresh oriented offering, but it could buy a store network, and if they were going to do that, would that have competitive implications for the UK? Absolutely, it would. So we are obviously thinking about those things. Is it immediately going to impact Tesco? No, it's not. But if Amazon wanted to try and replicate this, it's not as obvious how they could do that in the UK, but if they were, would that impact our investment case? Yes, it would.
Hamish, you mentioned Amazon, yet you don't own it. Maybe tell us why.
Frank, at the end of the day, first of all, I'd say I've mentioned Amazon because I actually think it's an amazing business led by an amazing founder in Jeff Bezos. As investors, we have to value businesses and we have to estimate what rate of return we think we're going to earn out of a business. In Amazon's case, there's very limited disclosure and we haven't yet got our mind around exactly what we think it's worth and the rate of return. We just don't own things because we think the businesses are great. We're in it to earn money, and to do that we have to do it on the basis of detailed analysis that we believe we've got fundamental backing to do that. So it's purely a question about, I don't yet have enough analysis that justifies the valuation case for me to buy Amazon. I just don't buy things on a hunch. I base it on very detailed analysis. We do. We have that analysis on Alphabet. We have it on Facebook. We don't have that analysis that tells me with a clear view what I think Amazon is worth at present.
Hamish, switching to macro for a minute, the Fed Reserve has recently announced its plans to taper its balance sheet. Can this destabilise markets?
Well, first of all, I'd say they've been quite clear on what their plans are going to be, and it's going to be a very steady program. They're saying from sometime later in this year, they're going to commence ceasing reinvestments of their securities portfolio, starting at about $10 billion a month, which is very small in the scheme of things, and over a year increasing on a quarterly basis up to $50 billion effectively of sales of securities per month. You have to also overlay in that what is the ECB going to do over that period ahead, maybe to the end of 2018. If Europe continues to stabilise and economic growth continues to pick up, and there are many positive indicators in Europe at the moment, we would expect that the ECB will taper or slow down its asset purchase program. Those two combined events are likely to lead to higher long-term interest rates in the world as that happens. That's assuming both those two things happen. The market's obviously betting that the Fed won't do this and the ECB won't taper, otherwise rates would have already gone up in expectation. So the market's somewhat doubtful whether this is actually going to happen or not. But if it does happen and rates go up, I wouldn't say that we're going to have a massively disruptive crash because this is fairly well signalled. But as rates go up, it's a headwind. So particularly equities or fixed income that is sensitive to longer term interest rates, some of their prices may well come back during this price, and it's part of the reason we're sitting in cash as we're watching this play itself out. We don't want to be investing into more defensive equities and hoping they're defensive. They're not very defensive. Their share prices are going backwards. They're dependent upon rates not going up at the moment, and the Fed says we're intending to do it. Let's see whether they do it or not. But I'm not going to bet against the Fed on this equation at the moment.
Thanks, Hamish.
A pleasure, Frank.
And thanks for watching. Feel free to forward this video link on to colleagues or clients that you think might be interested. And obviously you can find out more information on our website. Thanks.